Good afternoon, everybody. Good afternoon, and welcome to Marcellus's webinar with Swapnil Pawar. He's the author of a terrific book. The book is called Rethinking Money and Capital. The subtitle is New Economics for QE, Stimulus, Negative Interest, and Cryptocurrencies. And it's our privilege today to host him. Welcome to Marcellus's webinar, Swapnil.
Thanks, Saurabh. Great to be here.
So, folks, this is an unusually good book in the sense it's a book on economics written by a non-economist. I'll introduce you to Swapnil. You realize just what a unusually talented man he is. And then once I've done the introduction, I'll request Swapnil to take it from there and take you through some of the key things in the book. So, Swapnil is a Web3 entrepreneur. New RL, the public blockchain that his company has set up. New RL focuses on bringing Web3 innovations to real-world applications such as small business finance, carbon credits, fractional properties, and so on. He's also a formidable quant finance professional with over 18 years of experience. I've had the benefit of seeing just how switched on he is about quantitative finance. Besides that, he's a keen researcher of macro theory. Being an economist myself, I can tell you this man's depth of knowledge about macroeconomics is remarkable. He's written a book before this called Anatomy of Froth. This was after the global financial crisis. He's an IIT Bombay graduate and a postgraduate from IIM Ahmedabad, and he's a resident of Ahmedabad. So without further ado, let me hand over to Swapnil for him to take you through some of the key themes of his book, Rethinking Money and Capital. Over to you, Swapnil.
Thanks, Saurabh, for the kind introduction, and thanks everyone for joining in. Just a preamble to the book's theme. It sort of went hand in hand with my thinking process on Anatomy of Froth. Post the global financial crisis, one of the standard worry across the world was the QE will cause hyperinflation. And back then, I didn't know why it did or didn't cause it. But 2011-12 came and we still hadn't seen inflation above 2-3% in the US and similar numbers around the world. That intrigued me a bit and then a bit more. As I went down the rabbit hole, I figured out that a lot of what has been taught to us in economics is somewhat outdated, and in some cases extremely outdated. And then I thought of taking a little bit of a fresh outsider perspective to this, which is what I call stock flow consistent theory, which means balance sheets have to balance, and somebody's asset is somebody's liability, and so on and so forth. And then one starts to ask questions without ideology or theory, and some interesting answers come about. So that's been my journey in writing Rethinking Money and Capital. And so today we'll be focused on a few interesting themes from that. And of course, would love to keep it interactive and take questions towards the end. So let me just share my screen. So we talk about these 6 broad ideas from the book. Savings glut in what we call a post-industrial economy. And as the introduction also said, this is not to do with QE or this year or last year. This is just a secular trend over the last 2 to 3 decades, likely to continue. A new theory for negative risk-free interest rates. The endgame of what we call a free market capitalist economy. And then how can we actually avert it? Because some of these endgame 2 or 3 scenarios, out of the 2-3 scenarios, 2 are actually quite bad. And then one of the key ingredients of this, the institutional innovation is how to use fiscal deficits and monetary policy better. And it's a good thing to actually take on some of the myths surrounding fiscal deficits in that. And lastly, in the specific Indian context, we'll look at some ideas for aggressive growth, using banking system better, fiscal policy better, and so on. So diving in, the first theme, the savings glut in a post-industrial economy. Now, stalwarts like Ben Bernanke, who just got the Nobel Prize, have talked about savings glut for last 2-3 decades, actually, even before the global financial crisis. And there is a very specific reason for that. And this is not to do with just one specific country or one specific economy's idiosyncrasies. It's a secular trend. It's driven by a simple thing, that falling real investment in developed economies. So post World War II, there was this surge after Marshall Plan and so on, and then things sort of dwindled after the 80s in the global context. In China, it continued. In India, it continued, but there also it's starting to taper off as you just sort of run out of things to build. There's just so many factories you can build. There's only so many roads you can build, and so on and so forth. And there is, of course, the environmental limit that we are starting to push against in the second or third decade of this century. The other side of it is the steady demand for individual savings and corporate profits. This is what I call a mismatch of demand for money savings and supply of money savings. And we'll see graphically also on the next slide. Now, the steady demand for individual savings is essentially driven by retirement as an emergent institution of 20th century. Till 19th century, it was basically old people were cared for by younger people in the generation, and it was intergenerational rather than everybody saving for themselves. And in parallel, firms and capital markets activities became a lot more well-defined anchors of our economies, and profits is why firms exist. And so that demand for profits and individual savings is pretty steady. Whereas, as we see subsequently, the supply of money savings, if you will, or monetary savings is actually erratic, to say the least. Another crucial thing that happened in 1971, besides a lot of different interesting developments around the world, in the monetary macroeconomic context, there was one sea change, which was Richard Nixon actually switched US dollar from gold backing to fiat status. And that has changed the very dynamics of how money moves around the world, or money is created, destroyed, and saved, and so on. And that's created an abundance of financial capital. Now, I don't have a point of view on or a judgment about it being good or bad. Simple point is that it's fiat currencies, nominal cumulative capital keeps on growing nearly endlessly. And that has implications that we seem to not fully grasp if you just take a micro view of things. So that's the background. This is a slide to explain that a bit further, using actual...
Swapnil, if I just can come in there, right? So folks, just to sort of underscore the points that Swapnil is making, if you see India, you'll see in the last 20 years, there is no correlation at all in India between the prevalent interest rate and the capex cycle. So conventional economics says that capex will happen when interest rates are low. There is no such correlation, neither in India nor anywhere else in the world, which underscores the extent to which conventional economics, conventional macroeconomics has failed us. Back to you, Swapnil.
Absolutely. And Saurabh, to your point, additionally, even on the demand side, there is that general understanding that if the interest rates go up, the supply of savings, so to speak, goes up, and if interest rates fall, it actually falls. But there is, again, if somebody were to numerically, no correlation there either. So what Saurabh described was this item 1 here, which is real investments. And they, at least in our era, last 20, 30 years plus, aren't exactly a function of interest rates. They are a function of risk appetite and growth perception and liquidity in the system, rather than precise level of interest rates. And so we had Japan toying with near zero interest rates for 2-3 decades, well before GFC and other things. And yet the investments there remained quite subdued. Same thing in US immediately after financial crisis, interest rates were rock bottom, and yet investments were slow to pick up. If the risk appetite is low, interest rates are not going to get you to suddenly become risk taking. So what the flows here essentially come from real investments, fiscal deficit, money creation by central bank, realized cap gains, and trade surplus. This is what I call a cash flow consistent tracing of how profits and surpluses for any participants in the economy will come from. And so on the right-hand side, you see corporate profits, individual savings, capital export. Capital export is essentially things like Indian central bank or Chinese central bank buying US treasuries through their capital market interventions, or even individuals buying LRS and other such global assets. The other things, corporate profits, individual savings, these are where the sinks for money are, real money, if you will. And these are the sources, the 1, 2, 3, 4, 5. The thesis that we're working, the claim I'm making is that real investments are erratic. They're a function of how the companies see the macroeconomic situation and so on. Money creation by central bank is a matter of monetary policy. Cap gains are a function of how capital markets behave. And trade surplus is a function of how domestic and global economies work. So you actually have some of these autonomous elements moving around pretty erratically. And there is a secular fall in them. as we saw in the previous page as well. And that is what is leading to what we are increasingly seeing to be the endgame of capital, endgame of free market capitalism. Before we come to that, though, the second point we wanted to cover today was the interest rate logic. So lots has been said about interest rates over the last 10, 20 years, especially after the global financial crisis, where interest rates started pushing close to negative territories. And initially, there was this fear that if interest rates are negative, people will simply withdraw the cash from their bank accounts and stuff it in the mattresses. Interestingly enough, that never happened, despite actual deposit rates in banks in Germany being negative for several years, 2-3 years plus. People didn't actually take out money and stuff it in the mattresses. So small negative rates are actually quite okay with most people. And we're not even talking here about bank deposit rates. We're simply talking about risk-free rate on government securities, right? In that context, a new way of looking at this that we're proposing is interest rates were conventionally thought to be a reward for postponing consumption, which an individual requires or a firm requires to not consume today and leave it for tomorrow. And that is supposed to be good for the economy, because that way you can invest that money and build the productive capacity of the economy. That was what the conventional macroeconomics and microeconomics taught us. But that is what we call a real economy perspective, and that is indeed valid. But when you look at money economy, where money supply is not finite, and it's not, especially after 1971, it's not even controlled by a specific upper limit. You come to the complete 180-degree view of this, which is to say that, especially in the micro context, money actually is better than goods and services in the context that it's a call option. You can choose to spend it, you can choose not to spend it. Whereas if you actually have goods or services, you can only consume them. You can't save haircuts, or you can't save mobile phones. You can actually use them or not use them. Whereas money, you can save it indefinitely. Now, instead of seeing postponing consumption as a sacrifice, especially in our era of abundant savings, it's actually, for want of a better term, a selfish act. Let's just say it doesn't need an incentive. It almost needs a fee at a micro level, at least. And so from that perspective, and this argument is detailed further in the book, but this indicates that in a micro context, interest rates can be negative and yet people will save. And that, in fact, has been borne out by practice also. And in theory also, if you follow this line of thought, it does seem consistent. The other side, what should be the rate of interest be for an economy? There again, generally, you can think of economy at capacity, operating at full capacity as it is now, or economy operating with a slack as it was in 2020 and some part of 2021. If economy is operating in a slack, savings actually add to the slack. And that essentially means we see what Bertrand Russell and others call the paradox of thrift, which is that everybody says savings are good, you should actually live within your means and so on. But if everybody in the economy starts to live within their means, it'll be an endless game of musical chairs, because my saving is somebody else's, my spending is somebody else's revenue. So if I don't spend, somebody else's revenue goes down. And if they also try to save, despite this falling revenue or falling income, somebody else's revenue indeed will fall. And that sort of continues. In the real world, it gets plugged by the real investments by firm. But as we saw, these are erratic as a function of risk appetite and so many other things. So if an economy is not operating at full capacity, the act of saving is causing the situation to become worse, not better. And indeed, such an act should then have a fee in the form of a negative interest rate. So from both micro and macro context, we see that micro is typically negative risk-free rate in general as a theoretical outcome. In macro, risk-free rate should be negative in periods of slack, but they should be positive in periods of full capacity, which is, I guess, times like now. On the balance, if you add these two influences, in general, you will see negative to close to negative or very small positive risk-free rates in most instances. Two caveats here. we're talking only of risk-free rates. So, if you're taking credit risk or you're taking equity premium in the consideration, it will obviously still add a positive some number to it. So even if your risk-free rate by this theory comes out to be -2%, you can still expect bonds of high yield debt to be, say, -2% plus 5%, so plus 3%, and equity premium of say 9%, so you're still at about 7% positive. Likewise, this is, and the second caveat is it's a real rate. So if inflation is running at 7%, the real risk-free rate is say -2% as per this theory, we still have nominal rate of 5%, plus 5%. So with these two caveats, we start to come out of this scary territory of negative nominal rates for typical investments. So those are the two caveats I would make before actually moving forward. Salil, anything to add here, or Saurabh?
Very good, Swapnil. Please carry on.
So with that, then let's come to what is the end game of free market capitalist economy. And I'll give a bit of a preamble to how I came to this specific analysis, right? One of the things that the conventional theory, macroeconomic theory, teaches its students is the so-called representative agent. So if you ask a question about how does demand for a certain good or service in the economy respond to prices, you say, okay, for an individual, it is a downward sloping curve. So it is for the aggregate economy. So this generalization is actually mathematically not defendable. So it's a bit of a shortcut, and it's not actually a robust enough shortcut. As you can actually see from what I'm going to describe next, it actually is flawed enough to produce incorrect, grossly misleading results. So what's the alternative then? If you can't actually say that how would a typical person behave is how.
So Swapnil, just one other interaction. So folks, just again to underscore why Swapnil's book, his thinking is valuable is, I've seen several Indian central bank governors insist, several Indian central bank governors have insisted that we want real interest rate to be positive because that will encourage savings, right? And based on that premise, they've refused to cut rates as aggressively as they should. And that has repeatedly hurt the Indian economy. As Swapnil is saying, and there is solid empirical data to block back this, there is no evidence at all that positive real rates actually lead to more savings. There is no correlation between the positive or negative real rates and savings. And yet, because our central bank governors historically, using flawed macroeconomics, have tried to keep real rates positive, India has had higher interest rates than it should have, which has in turn hurt the economy needlessly. So this belief in wrong economic theories, which permeates popular media discussions, which populates what the brokerages churn out, which populates what our central bankers believe, is harmful. You and I don't have to participate in the mindless group think. And if we make sensible decisions basis first principles thinking of the sort Swapnil is laying out, we'll usually end up making better investment decisions. Back to you, Swapnil.
Absolutely. Couldn't agree more, Saurabh, because we often mistake the fact that the risk premia are confused with risk-free. And so risk-free being negative is still leaving a lot of room for people to decide where they want to land up on the risk return curve. And if you want to be still safe, you can actually still choose to invest very conservatively and so on. So there is no such thing as financial depression that people keep crying about when they are told of negative real rates. We've seen the example of China. Rates have been low for long enough, and that has helped the economy quite well to become pretty much the competition to US economy. Now, coming to the end game of free market capitalist economy, I was talking about the representative economic agent and how that thinking has made for fairly poor economic models in mainstream economics. The alternative is you don't think of it as one person multiplied by 1 billion to arrive at the behavior of 1 billion. You actually, in today's day and age, can actually run a simulation of 1 billion individual agents given simple rules, which we refer to as locally consistent. There is no God's eye view of these representative agents. They're not these godlike rational economic agents that most of the economics textbooks talk about. They're simple agents who represent simple human beings who say prices go up, they'll try to find a substitute. They'll try to match their incomes with their expenses. They'll have some short-term view of where the world is going, but no major forecasts and so on and so forth. And they adjust their behavior. So if they actually feel that twice they actually try to bid for some good and they didn't get it because the price was too high, they increase the price and so on. So there's no external agency telling them that this is the demand curve and you should spot here. Long story short, if you actually run a simulation, and I spent like several months trying to write the right program and so on, you come to fairly interesting outcomes of these simulations. And one of the most stark outcomes for me, and I almost initially thought there was a bug in my program, so I checked it several times. There wasn't a bug. We realized that this is how a real economy would behave in the medium to long term, starting where we are now, which is that the real consumption and investments will keep falling and concentration of wealth will keep increasing. Part of this is driven by what we called earlier the mismatch between savings and investments, right? So in that picture, if I were to go back to that quickly, I talked about these 5 sources. Now, leaving aside money creation by central bank, which is obviously fraught with political challenges, and exports and imports, obviously each country has its own idiosyncrasies. And 3 also is a function of capital markets. So you're left with 1 and 2, real investments and fiscal deficit. So if real investments secularly fall, which is the post-industrial era we live in, and fiscal deficits are capped because of poor macroeconomic policy making, then you run into a situation where this pool is not adequate to satisfy the demands of savings and profits by the participants in the economy, who will, if they want to stay stubborn to their demands of savings, will keep on reducing their consumption. And then that will lead to a falling cycle of consumption and investment. And in such a situation, a firm is also rational to say that I don't want to invest in capacity expansion because demand is falling. So why should I invest? And that becomes self-fulfilling. Other than some technological breakthroughs, in general, you will see this leading to extreme concentration of wealth and a fairly poor, bare bones consumption for a large bulk of the masses. So this is what we call the quasi-feudal outcome of the free market capitalist economy's free run.
And again, permit me to interrupt, Swapnil, unless people like you, unless your books and your intellectual currency rises, this is exactly the sort of risk we face, that this false notion that fiscal deficits have to be kept under check runs amok. If those false notions run amok, that fiscal rectitude has to be maintained at the national level, given that there is no natural trigger for capex, even in a country like India. Increasingly, India is about capitalism. Without capital, it's not obvious that we need tons of capex on steel plants and power plants. So the capex engine on your PowerPoint is not going to be roaring for there's no obvious reasons for the capex engine to roar in India. If over and above that, the government sort of insists on maintaining fiscal rectitude, both in the West and in India, we potentially end up in that scenario number 2.
Absolutely. And one is still you start to get to the point of very high debt to GDP ratios, which, as you correctly pointed out, it's unstable because people will always have some bit of discomfort because of just legacy reasons and ideological reasons to government debt being seen as a bad thing, unvarnished bad thing, let's say. So where do we go from here? Like, that's the end game. If we leave things as they are, we actually might end up in this situation. And the early signs, especially in the last 10 odd years, are in this direction. In US, in India, in China, in Europe, in UK, most other places, this is indeed the path. At least secular trend is in this direction. The details may differ from a COVID to a war, but the secular path is in this direction. So where is it coming from? This is not a challenge of what I call a technology not being adequate and so on. This is an institutional challenge. This is how the profit-seeking firm and saving-seeking individuals' behavior is situated in the modern capitalist economy. In absence of institutional innovation, this is where we'll go. Now, the central theme of the solution is counter-cyclical fiscal and monetary policy. So what I mean by that is deficits when economy is in slack, and balanced and surplus budget when economy is running red hot. A lot of opponents of the so-called Keynesian view, this is basically what Keynes also said, is typically ignore the second half of this. And they point to how the 70s US ran a bunch of deficits and ran into serious inflation problem. Or now we're seeing inflation because a lot of fiscal deficits happened over the last 2 years. This is a fine balancing act for sure. There are no two ways about it. We're not saying run fiscal deficit at all times. If the economy is running red hot, the government should actually run a surplus or at least a balanced budget. It goes without saying, at least in this theory. And likewise, in the monetary policy, countercyclicality means pretty much the opposite of what most banks did, central banks did. So when the economy is going through a rough patch, you want banks to be a little bit more relaxed about capital adequacy, not tighten it. The credit supply needs to be easier because the risk appetite is anyway low in the economy. So anyway, people are going to borrow a bit lesser. So now you put additional capital adequacy requirements on banks, which are already running into some losses, maybe because of NPAs and so on. You're just going to make it worse, which is what happened in 2014 in India, 12-13 in India. So the reverse is what exactly is needed, which is if the economy is running red hot, you actually make capital adequacy much tighter so that people are dissuaded from making quote unquote unwise investments or acquisitions funded by leverage and so on. Bad times, you actually make it easier for people to borrow. If there are good real investments to make, it is easier to come by. Now, linked to counter-cyclicality are 2-3 other things, and UBI in particular. And this is one of my favorite themes because it's very grossly misunderstood in most of mainstream discourse. Universal basic income is thought of as a dole, something like it's just sort of a giveaway, and it's giveaway because we can afford it, but otherwise it's a bad policy which people want to sort of just live with. It's an apologetic. Even the proponents of UBI are very apologetic about it, which is conceptually incorrect, because if you run the agent-based models, some versions of it, which I did as well, UBI benefits the economy's most capitalist subsets also. It essentially means, what does UBI mean? You give money to the entire population. What does at least the bottom half of the population do? They spend it. What do they spend it on? They consume it. They'll buy mobile data, they'll buy grains, they'll buy oil, they'll travel around a bit more. And that money goes where? It goes into the pockets of people who are running the big companies, just supplying all this. So the profits of entrepreneurs and capitalists actually go up because of UBI. And it actually benefits the economy in keeping the slack to a minimum, making capacity utilization very high. And most importantly, in the context of economies like India, it actually gives the entrepreneurs and companies the comfort that the consumption will be there. So they can invest in capacity expansion because there'll be money for their goods and services when those are produced. And it's not left to only the vagaries of economic cycles.
And it's ironic in that context, Swapnil, the recent debate in India on freebies, right?
Yeah.
Arguably, we need more midday meals, not less. We need more NREGA, not less. But again, because there is muddled thinking on economics by our professional economists, the political discourse also gets colored with muddled thinking.
Absolutely. I agree. In fact, Endgame was one of the finer aspects of policy making in the last 10 years, and that did help a lot to bring down the difference in real wages in formal and informal sectors. It did help the average Indian a whole lot, and the bottom half benefited significantly from it. If not directly, at least indirectly, when it puts slightly upward pressure on rural wages, which if you take out Endgame, then the rural wages have just not moved at all over the last 10 years in real terms. Whereas corporate,
the result of that is FMCG companies who used to have 12% volume growth now have 5%, or that also is probably a good year, 2%, right? So a giant industry, FMCG, was a direct beneficiary of NREGA, and we have taken that, because of the popular discourse from economics that deficit kam karo, we have taken a powerful benefit. We're gradually throttling off on a powerful benefit.
Absolutely. And if I were to take even a purely utilitarian standpoint of John Stuart Mill, which is maximum happiness for maximum number of people, if bottom half of the economy is consuming slightly more than what it would without UBI, and the richer people are better off also in the whole process, I don't know who loses. That's the thing, which is it's bizarre, except for a fiscal deficit issue. Everybody else is happy.
Back to you, Swapnil. Carry on.
And so second thing, which is deficit spending on public goods. And this is one of my favorite themes again, which is when we were growing up in the 90s, we thought 2020 would see flying cars, and there are no flying cars around. And this is obviously, it's not a flippant observation. It's more like the pace of innovation in manufacturing and other such industries has actually gone down sharply after the Cold War. And that's partly because public funding of innovation has just gone down, and innovation even at a corporate level has come down, and it is now left with just top 5 tech companies to push everything. So if you actually, even if you don't support UBI, you can still support deficit funding on public goods like infrastructure, blue sky innovation, climate oriented policies, and so on. To that extent, BN has done reasonably well on this IRA Act, which benefit everyone. And so you can't point out and say this is actually bad for the economy, because when I say public goods, I mean goods which otherwise will not be provided by private sector. So blue sky innovation is an example of that, because these are too much of a moonshot. So that can only happen in a university or in a government funded institution. So space program, for example, seems like a wasteful thing in a poor country like India, but some of the most interesting innovations that are used in our households actually have come from space program as a fallout of it. So when you push for something like that in the university level, there are lots of these side effects will actually give you very workable, simple products for common use. So things like that. And then lastly, promoting risk taking, which is given the public markets and the sort of financialization of pretty much everything under the sun has led to a risk aversion even in listed companies. And there is a general, quarter-on-quarter focus, which I'm sure Saurabh you would have seen in so many of these quarterly calls, that there is so much more a company can do if it has a cash buffer and so on, but they're so focused on the short-term profitability that just give up on so many opportunities for innovation and long-term growth.
Fantastic. So folks, feel free to fire in questions. We've got Swapnil till 7 o'clock. If you keep pumping in your questions into the Q&A box in Zoom, my colleague Salil will take as many of them as possible. Swapnil, back to you. Once you've done with the presentation, Salil, if you can begin taking as many of the clients' questions as you can.
Sounds good. So let me just quickly go through the myths surrounding the fiscal deficit. So we talked about some of this during the previous few minutes, but specific ones here are fiscal responsibility myth, which is since as a household, we're always taught that don't spend beyond your means. And that's actually a good, I'm not disputing that. But for a country, it's false. You'll see the details in the book, so I don't want to go through the full argument here, but it just, it can be mathematically proven to be false. It's not fiscally responsible to balance your budgets at all times and even run a surplus. So running surplus is even bigger problem, but let's park that as a thought. Second common refrain is we're burdening the future generations with fiscal deficit of today. And the IRA actually runs a clock in US, which is just tracking dollar by dollar how much debt US is taking. It's also a false thinking, because we are not indebted to Mars or Venus. We're all a closed economy. We're just humans, right? So the public deficit is a mirror image of private wealth. This public debt is not held by Martians. It's held by humans who are richer for that reason. So whosoever saved and invested in the debt of the government owns that debt. So future generations of some people are poorer, some people are richer. It's not that we're just burdening future generation with it. Same thing with crowding out. When the economy is running at full capacity, I agree with this. This is not crowding out for savings pool. This is crowding out from resources available for this year's consumption. From that angle, one does crowd out in a full capacity economy, which is rarity though. Normal economies operate below full capacity. In that case, there is no savings pool from which government is taking some and the private sector taking some. There is so-called endogenous money theory, which again is not mine or anybody else's. It's more like an established truth now, accepted by the Fed, ECB, and all others. Money supply is endogenous to the economy. It's not top-down imposed by central bank. So there's no finite pool of savings. There is as much money available as is the risk appetite of the participants in the economy. So the government is not crowding you out. In many cases, actually, like we saw on the previous slide, if UBI were to be funded by fiscal deficit, that gave money to individuals to buy products and goods from companies, might actually prompt crowding in. So that distinction has to be made. And last is default on public debt. So people say, where is it going to go finally? We're just going to default on our debt. So details again in the book, but no sovereign country can be forced to default on its local currency debt. To be very clear, it's local currency. So Argentinian default is real, but US can't default on dollar debt and Japan can't default on yen debt because it's fiat currencies. They're not gold back. It's not gold standard. Ideology aside, whether it's good or bad.
Just to tease out a practical implication of that for India, right? If you think about it, was COVID obviously made low-income people terrified about exigencies of life. And therefore, naturally, low-income people at the poorest strata of society, are now trying to do some precautionary saving to make sure they have a buffer for the next COVID. The logical thing for India to do at this juncture is, rather than worry about the budget deficit, the logical thing for India to do at this juncture will be to roll out a welfare state to buffer the poorest people in society, so that they, rather than doing precautionary savings at the individual level, which is counterproductive, they go and consume, rev the economy up, generate GDP growth. Instead, lost in this false myth that there's something wrong with the fiscal deficit, lost in this false myth of crowding out, lost in the third false myth that higher interest rates or higher government debt will mean lower capex. We are doing a whole bunch of counterproductive things, which is tightening fiscal policy. This year, the government wants to tighten fiscal policy, and that doesn't make any logical sense at all, right, at many rational levels. So folks, keep pumping on those questions. Read the book, right? This is a super book to read. It's based in sound reading, logic, and it also rebuts a lot of nonsense that gets paraded out in public life, nonsense which hurts nations, which hurts individuals, which results in people taking counterproductive action. Swapnil, if you could just dwell one more minute on this whole point you're making, that the low cost of capital is not because of quantitative easing. It's not as if the US has gifted the world cheap capital. The low cost of capital is because we have excess savings the world over, and that's driving down the long-term cost of capital, which is not something that a central bank controls. If you could help our audience understand that, because a lot of people have got this mistaken notion that somehow money is going to become dearer just because the Fed has decided to do something or the other.
Certainly. So in fact, this goes back to what we call in the previous slide, the steady demand for individual savings and corporate profits, right? That's in some sense at the heart of this, which is savings are cumulative at the end of the day. So your net worth is cumulative. Last year's plus this year's savings will add up to the next year's and so on. And after the fiat currency, moving from gold standard to fiat currency since 1971, financial capital is in abundance. So now you actually have a situation where, in a secular sense, the richer half of the population is saving. And interestingly enough, as one of the articles in Economies also pointed out, if the interest rates fall, they save even more because they want to get to a certain target corpus of retirement. But that complex relationship aside, there is a steady demand for savings, which just is not going to go away whether interest rates rise or fall. And there is, of course, the structural design of a corporate economy, which is for profits. So these, coupled with the fact that real investments are actually falling, means that you're going to actually have an abundance of financial capital, money and financial capital floating about to look for opportunities to deploy it. And whether it's interest rates are by policy kept low or higher, this money is not going away. This is there in the world. So that false notion that because US is raising interest rates, suddenly money supply is going to fall is based on similarly incorrect stock flow consistent logic.
Salil, over to you to take some of the questions from clients.
Sure, Saurabh. So we have got a lot of interesting ones coming in. Swapnil, let's start with one. You mentioned about how low interest rates in China have helped the Chinese economy growth. Anirudh Datta is asking, hasn't the low interest rate in China and the misunderstood financial repression led to misallocation of capital?
So it's actually been a very long debate in monetary policy that if interest rates are low, people will make all sorts of bad investments. If government decides to take a lead in public spending, bad decisions will be made. This seems to make a simple assumption that just because something is cheaper or costlier, independent of the risk appetite and other governance structures around things, decisions will get skewed by that. The other linked assumption here is that the interests of people who are looking to earn fixed interest on their financial capital outweigh the interests of the economy as a whole. So John Maynard Keynes called the former group the rentiers, right? Because they just basically saying, I got some money, I don't want to risk it at all. So that's why I'm putting in government debt. And please give me 5% a year or 7% a year. Whereas the hardworking entrepreneur is saying, look, I'm putting all my money in my business, and that might actually go down, it might go up, I might make 10x, but it's risky. And people investing in equity markets like you guys, taking the risk that markets may actually not do well this year or next year, you don't know, right? There is a lot of volatility in that. So risk should get paid for, that is clear. But calling low interest rate at the risk-free level financial repression is the exact opposite of what I refer to as natural rate of interest rates. Real interest rate, real risk-free interest rate is actually negative because money is a call option versus goods which are consumed or not. Likewise, economy in slack, savings hurt the economy as against benefiting it.
Thanks, Swapnil. Now we have a couple of questions on savings, right? So we'll take it up from the answer that you were just giving. Is that given the effect or impact that excess savings is having on economies worldwide, should governments even think of, let's say, actively or deliberately trying to discourage savings?
So that actually inverts the logic. The problem is not with savings, right? People will continue to save because why do people save? I mean, in my book, I talk about 8 reasons, but leaving aside the exigencies and some goal-based investing aside, most of the richer people save, actively save primarily for retirement and building a corpus for inheritance. And others have indirect savings because they are so rich that their savings keep accruing by virtue of dividends and so on, which are not actively planned, if you will. Now, their behavior is not a function of what is the interest rate level. If you're building a retirement corpus, it wouldn't matter if the interest rate is 1% or 5%. In fact, 1% is counterproductive because at 5, you might actually save a little lesser, not more. So the answer is not so much in trying to change people's saving behavior. The answer is trying to fulfill it. So if I were to look at that slide that I talked about, instead of changing the behavior on the right-hand side here and saying, we should try to discourage money savings here, try to get the policies right on this side of the table and say, how can we keep the pool of money savings relatively constant year on year so that nobody goes home disappointed and economy operates at good capacity and people invest. The real investments make up for most of the future pool of savings.
Right. The next set of couple of questions are on fiscal deficit and how it is financed. And there's one by Sridhar, and he says that if fiscal deficit is financed by domestic debt, it probably seems all right. But what are the impact or what could happen if there's an external debt that is taken on to fund the deficit?
So external debt, suddenly the myths start to sound like realities. So so if I go through the fact of fiscal responsibility, I would never recommend any country to borrow from outside unless it is absolutely must and there is no other alternative. So global funding of debt is like a company borrowing. And so over leveraging in that context is as damaging as bad over leverage for a company is. So there you obviously have to live within your means. You have to look at your current account balance, capital account balance, and so on. So of course, Argentina is mismanaging external debt. There is no doubt about that. But the question is, especially for large economies like India, Indonesia, Turkey, and so on, there is enough domestic supply of savings, so to speak. And the domestic banking system is big enough to support fiscal deficit, especially if it is countercyclical. So why head out? Why go out in the world to borrow?
So arguably, and this is why I think, again, I can't recommend Swapnil's book enough, especially if there's a policymaker watching. Please read this book. It will help you a lot. I think a lot of fiscal policy in India is based on deeply misguided thinking. Arguably, East Asia's rise was because they did not follow the nostrums of conventional Western economic thought. So if you take, say, Japan, for instance, the Japanese government effectively gave the Japanese banking system a bank guarantee, a sovereign guarantee. The Japanese government through the 70s gave the Japanese banking system a sovereign guarantee. They said, "Jaake paisa lend karo. If the corporate defaults, we, the government, will make it good for you." Right? In modern parlance, they reduced the capital adequacy requirements. In modern parlance, the government effectively injected equity capital. The government took public's money, de facto. This is not de jure. The government took public money and told the Japanese banks, go and lend to Mitsubishi, Toshiba, Sony, Honda, Kawasaki, etc. And the banks then lent at lower interest rates than they would have otherwise, and they built modern Japan. Right? Now, that is not something conventional economics would have recommended. They would have said government is taking on contingent liabilities. They would have said government is breaking the balance sheet. Thankfully, the Japanese government didn't listen to the to Washington consensus, and they built modern Japan. Right? For a poor country like India, it is really, really important to understand this point that if Saurabh Mukherjee saves more money and the government of India does deficit spending, that is actually making a lot of sense, because Saurabh Mukherjee's savings is funding the government's deficit. Now, the implicit assumption people then make is government ka deficit बढ़ रहा है, government will go and will misspend the money, कोई रिश्वतखोरी हो जाएगा, some sleaze will happen, but that's not a necessary addition. Right? Whether the government runs a budget deficit of 5% or 0%, if the government is misspending money, you've got a different problem altogether. Now just imagine the government runs a budget deficit, but the government takes that money and, for the sake of argument, gives it to HDFC Bank and says, HDFC Bank, using this money from the government, give out cheaper loans to deserving corporates. Right? And you immediately see how the government running a higher deficit can actually be good for the country. The government takes money, gives it to HDFC Bank, ICICI Bank, Kotak Bank, whoever, and says, boss, aap paisa lend karo to sensible corporates, but do it at a lower rate than you would have done otherwise, because I'm the government, I'm giving you all this sasta paisa. Right? And that's the kind of thinking we need in India today, rather than this crazy notion, economy is growing at 6-7%, and we got people jumping up and down saying budget deficit zyada aa raha hai.
True. In fact, one of the recommendations in the book also described is bringing back DFIs, but not as DFIs, but as banks. So one of the problems in India, for example, with IFCI, ICICI, not the banks, the limited, ICICI Limited, IDBI Limited, and so on, was that they were not banks. So they couldn't sort of participate in interbank market and so on and so forth. They had to borrow from public and then fund it all. And then that obviously led to its own complications. And they weren't formally supported by the government beyond some vague implicit guarantee. To your point, if there is an explicit guarantee, that will go much longer in making this a productive arrangement. And I would go one step further and say, create a living will of sorts, and like a bad bank built into the system, that we'll know that there'll be some NPAs, and instead of them hobbling the system as a whole, we have the bad bank design ready from day one. And as the loans accumulate, they keep going here. We have to solve for agency problems separately, but you keep the design in the mix right from day one. You know that you can handle some amount of NPAs at least structurally.
Right. Thanks. So the next couple of questions are on taxation. Right. So on one side you have income and savings that get impacted by taxation. On the other side is how the fiscal deficit gets funded. Any views on what the government should do or think about personal income tax as a measure of either influencing either side of the equation?
So, well, here the question boils down to what can promote spending in the economy and how can you keep it relatively egalitarian, right? So if I were to be given a free hand in designing taxes, I would say reduce taxes on consumption or make them more uniform, like put a single GST rate of 5%, 6% and be done with it, except for some very exceptional circumstances. Keep it uniform, keep it small. That is egalitarian. And then have a income tax rate, which is again relatively uniform across all categories, not too many exemptions, simple rising if required, but don't look at taxes as a way of quote unquote funding the expenditure. Instead, they are more policy of redistribution, if anything. And most of your math can work very well through simply making sure that you actually have fiscal deficit funded by domestic debt at low interest rates. So use taxes predominantly for redistributive purposes, not so much for getting your fiscal deficit in check.
Right. Now here's an interesting question, and as a non-economist, I'll also try and give some perspective or give an angle on this. Is that as an economist, you're thinking rationally, you're thinking very objectively. This question is from Mr. K.D. Shah, and he says that direct benefit schemes or UBI will have its merit as you think like an economist. Does this not reduce overall productivity in an economy because people get paid for not doing work? So is there a social angle that you think that you can chip in as in?
There is. In fact, I did think about it quite seriously. In fact, one of the very nice books written by Karl Polanyi on the Great Transformation, he calls it. He talks about the 17th century England, where there are people who the church was supporting through something called rates. The church just used to give away money to these people to survive, and that was enough to survive. And so people just sort of dropped out of work, what do you call the active labor pool, and that was indeed exactly like you mentioned. It reduced the labor supply and it promoted a certain apathy to work and a certain sense of entitlement, if you will. So one has to be very careful while designing UBI. Couple of pointers here. One, I don't think UBI should be for poor people or rich people. It's basically UBI's, the U is universal. Right from Mr. Mukesh Ambani to the youngest kid, on the earning the least amount of money, everybody should get the same amount. The rich can, like the gas subsidies we decided to let go, people can opt in to say, I don't want it. But at least from a justice perspective, it is simple. It's for everyone, no matter, like for every adult. It doesn't matter what your income status is. Secondly, it's counter-cyclical. So people aren't guaranteed a UBI every year of a certain amount that they can rely on to not work. So it's almost like saying that, look, I'm going to get maybe 5,000 rupees a month. I might get 25, I might get 0. Because if the economy is red hot, the unemployment rate is rock bottom, it's quite likely I'll find work if I look hard enough. And so in that year, if I get only 1,000 or 0, I'm going to be okay. But if the unemployment rate is 10% or 15%, and I'm getting 25,000 rupees a month, that is the godsend. I'm not going to stop working because of just the 25,000, especially if I know that next year it might turn out to be 5,000. So keeping it counter-cyclical and uniform across all participants might make it a little bit less prone to making it anti-work or anti-productivity, if you will.
And just to sort of reiterate that, just to take an example of where we might have screwed up. So if you think about NREGA, as Swapnil is saying, was a great idea, nowhere more evident than in the deepest, direst days of COVID, where the government's NREGA payouts, there's actually research that Arvind Virmani and Surjit Bhalla have published showing that the government social security payouts through COVID kept millions of people off the poverty line. I think through the COVID, roughly 2 years of COVID, the Indian government paid out $250 to $300 billion of social security payments, right? Ideally done and brilliantly done at period of great need. Where the reverse was true is when the economy was roaring through 2009, 10, 11, and we were doing heavy social security payments, the result was 10, 11, 12% inflation, and arguably it cost the UPA. It cost the UPA there, the 2014 election. So if you just say, I'll do UBI, and you don't take cognizance of broader macro conditions, broader demand conditions, obviously, if you keep doing UBI in a roaring economy, you will fuel inflation. But not to do UBI when the economy is soft and it's weak, and not to take hits on the budget deficit when the economy is soft doesn't make sense. Now, through COVID, thankfully, the government said, we will ignore all this nonsense about fiscal rectitude. And I thought the government did the right thing by ramping up fiscal deficits through COVID. What's not clear to people like us is why this sudden, enormous focus on fiscal rectitude. A lot of people say, well, the credit rating chala jayega, global rating agency will downgrade us. There is very little correlation, again, between the rating agency's actions on sovereign debt and actual 10-year bond yields, right? Because the long-term 10-year bond yield is not because S&P or Moody's have given it to us. The long-term 10-year bond yield on the Indian rupee is domestic demand supply on savings. So this notion that we should take cognizance of what Moody's or S&P has to say about India and run low budget deficits, it doesn't make any sense.
Absolutely. And having Greek economies rating similar to India's was sort of a joke in S&P's rating system. I mean, I wouldn't really put the two economies' ability to service debt at par with each other. So, and one sub point of what Saurabh said I would make here is the need to separate fiscal policy from expenditure policy. And to me, fiscal policy is very simple. What is the nominal demand gap and how can we fill it using fiscal deficit? And that's a numerical output. It doesn't say what you should spend it on. There are good reasons good ways to figure out what to spend it on and so on. UBI is a very good subset. You can do public works and you can have discretionary, where time is discretionary. You can do it this year as well as next year. You might as well do it in the years of slack. So that arrangement is for the government's expenditure policy team to make. Fiscal policy is simply to say, we are running a slack of 12%. And so our deficit target this year should be this much. This is not fiscal. This is what I call fiscal responsibility, in fact, to run a fiscal deficit in times of slack. And I would also go the other way around and say, if the economy is running red hot, you actually say, I want to do a balanced budget this year, no matter what the expenditure demands are. And if you want to raise taxes, do that. But I want a balanced budget this year because economy is running in inflation. So that has to come from an independent board almost, like a central bank runs in interest rate policy. You should have a fiscal policy board which runs this number, which is crucial for macro stability. And then the finance department takes over and says, okay, what do we spend on this year?
Right. So we have time, but I'm going to just take two last questions. One is, when Swapnil mentioned that you should focus on the left side of the equation that you have on an earlier slide, right? Not look at this year. Yeah, you look now. What this requires is very strong institutions within the economy, right? And a lot of kind of separation of the political economy with the economy, right? So Anirudh Joshi has related questions on this. Is that all this is fine, but practically in India or in a country like India, you think this is possible? Or is it practical?
So in fact, I maybe preemptively answered that with the fiscal policy board logic, which is many of these things can't be left to year decision making right from scratch. So every year we can't get into the debate of is fiscal deficit crowding in or crowding out. Some of these questions are evergreen and answers are evergreen. Then you need institutions which actually keep an eye on the macro context and then say, this year we'll do UBI of that much, and this year we'll do capital adequacy ratio of this much, keeping in mind where the economy has been and where it is likely to go. So instead of just focusing on this one parameter saying interest rates will go up during inflationary periods and down during low growth periods, we actually have a collective of these 3-4 decision variables which maybe different bodies look after institutionally. So central bank has been a very interesting institutional experiment in the last 100 odd years. There's no reason we need to stop at that. Each of these things are so important that they can actually be run by a set of experts, still overseen by the finance ministry and the democratically elected representatives. I'm a big fan of that. There shouldn't be like a technocracy saying, they are better than everybody else. But it's institutionalized, so actually what thinking goes in making those recommendations.
All right. And the last question, this is in the title of your book, so we should have expected a series of questions on these, is the cryptocurrencies. Right now, what do you think of the role of cryptocurrencies? Was this just some speculative asset or initiative that is died down? Does it really have a role in an economy?
I mean, we are talking about this at a timely, I mean, it's fortuitous that it happened a couple of days after the RBI came out with the CBDC circular. And so for me, and I spend most of my time in Web3. So for me, cryptocurrency has confused people by virtue of conflicting two things: the technological innovation, which is decentralized currency and smart contracts, and the ideological point of view that the Bitcoin guys had when they started, which is fiat currency is dead. The thing is, what prompted me to start the research in this book, which is hyperinflation and the scare of it and the fact that it didn't materialize. That's what prompted Bitcoin guys to create Bitcoin. And when the hyperinflation didn't materialize, technically the logic for Bitcoin is over. So I actually don't believe in Bitcoin's currency aspect or anything in Web3 which is to do with replacing fiat currency. I do have a lot of respect for all fiat currencies. And I think currencies should remain fiat and under the democratically elected government's control. So if you take out that ideological point, the decentralized economy point, decentralized finance, and actually making smart money. So for example, if the government is making payments for subsidies, there's a lot of leakage, right? If you actually make smart money where you say that this money can only be spent on food, then suddenly you realize that you're not going to hoard it as a corrupt intermediary, because you're not going to buy so much food. So you can actually create so many other innovations here where debts can auto settle upon default. The currencies, I mean, so the security can go to the person who the lender and so on. You can create micro banks of people who are community lenders, cooperative banks without the political influence, and so on and so forth. All these innovations are possible in a decentralized finance context, and a CBDC or a smart money of any sort or a stable coin will actually give it a lot of fillip. So from that angle, I do think the decentralized economy is here to stay. Cryptocurrencies will probably go extinct after 5, 6, 10 years, but smart contracts and public blockchains, they'll definitely be here.
Great. This is, I think, the most eye-opening explanation on the use of DeFi that I've ever heard. So thanks, Swapnil. I think we're out of time. Saurabh, back to you.
Let me just quickly bring out 3 points, folks, that regardless of what the government does, here's 3 things you can benefit from reading Swapnil's book, Rethinking Money and Capital. Firstly, the fact that cost of money is low is not because of the US central bank. The US 10-year bond deal, the Indian 10-year bond deal is not driven by the Fed. Money is cheap, will remain cheap because there's a glut of savings. It will carry on for many years. Secondly, the way the free market currently works and the way muddled up economics is muddling the heads of authorities the world over. This construct of economics, as Swapnil explains and Thomas Piketty has also explained, is going to lead to huge polarization in economic life and corporate life. A few people will control a lot of wealth. They will control the bulk of the profits in the country. You and I can make money from that. We need to understand that that's the way free market economics works. And thirdly, as Swapnil explains, fiat currency is here to stay. Crypto as a replacement of fiat currency is an illogical measure. Crypto has other positive uses, which Swapnil's book nicely laid out. Thank you very much, Swapnil. Thanks to everybody who's dialed in.
Thanks for having me over. Thanks, Salil. Thanks, everyone.
Bye.
Bye.